You sell a winning stock to rebalance your portfolio. It feels responsible, disciplined, even. But in a taxable account, that single sale can hand 15% of your gain straight to the tax bill. And that money? It's gone for good. It stops compounding the second you sell. Here's the part nobody tells you. Rebalancing, the thing every advisor says to do, can quietly cost you more than the imbalance you're trying to fix. So here's the answer up front. You almost never need to sell your winners to rebalance. The most tax-efficient fix is cash flow rebalancing. You point your new contributions and dividends at whatever's underweight, and let the imbalance correct itself with zero taxes. Selling should be your last move, not your first. Let me show you the math that makes this obvious. Start with what selling actually does. In a taxable brokerage account, when you sell an appreciated stock, you realize a capital gain, and that gain flows straight onto your tax return. Imagine an investor in Massachusetts. They bought a share at $100. It's now worth $200. That's $100 of gain on one share. If they've held it less than a year, that's a short-term gain, taxed like ordinary income. For a typical middle-bracket investor, federal plus state lands somewhere around 30%. So selling that one share costs $30 in tax. $30 doesn't sound like much, but scale it up. Sell $5,000 of a stock with a $2,500 cost basis, and you've got a $2,500 gain. At 30%, that's $750 gone. Not deferred, gone. And it's $750 that will never compound for you again. Now here's the number that should stop you cold. Most people sell a winner intending to buy it back later or rotate into something similar. So ask, how far does that stock have to fall before selling and rebuying actually beats just holding? The math is simple. Take your tax cost per share, divide it by the sale price. On our doubled stock, $200, $30 of short-term tax, that's 30 divided by 200. 15%. 15%. The stock has to drop 15% before you come out ahead versus doing nothing. If you held it long enough to get the long-term rate, around 20% combined, the tax is $20, and the break-even drop is 10%. Either way, you're starting the round trip in a deep hole you dug yourself. So if selling is so expensive, how do you keep your allocation in line? You use the money already flowing into your account. Every contribution, every reinvested dividend, point it at whatever's underweight. Say you add $12,000 a year, and your bonds have drifted $9,000 below target. Put the whole $12,000 into bonds. You've just done 75% of your rebalance and triggered exactly zero in taxes. This is the most tax-efficient rebalancing method there is, full stop. And if you're still in the saving phase, regularly adding money, this alone can keep you balanced for years before you ever have to sell a single share. Now, this isn't never sell. It's sell deliberately. Two things change the answer. First, the size of the drift. If a position is only a little off target and the tax bill to fix it is real, don't sell. Use new money. But if a holding has ballooned to where it's a genuine risk to your whole portfolio, the drift is big enough that selling earns its tax cost. A rough line a lot of disciplined investors use. Roughly 20% off your target weight before a taxable sale is even on the table. Second, the account. Everything I just said is about taxable accounts. Inside a 401k or an IRA, selling triggers no tax at all. So if you need to rebalance hard, do it there first. It's free. Here's the honest other side. There's a real danger in taking don't sell too far. If you let a winner run forever because you don't want the tax bill, you can wake up with one stock making up 40% of your portfolio. That's not a portfolio, that's a single point of failure. If that one company stumbles, the tax you saved won't cover what you lose. The tax tail should never wag the investment dog. The point isn't to avoid selling at all costs. It's to make selling a deliberate decision, with the math in front of you, in the right account, instead of a reflex. So the one thing to remember, before you sell a winner to rebalance, run the tax number. Tax cost divided by sale price tells you how far the stock has to fall before that sale was worth it. Most of the time, you'll find it's cheaper to just point your next contributions at whatever's lagging and let the imbalance heal itself. Sell winners when the drift is genuinely dangerous or when you can do it inside a tax-sheltered account. Otherwise, the most expensive button in investing might be the one labeled sell. That's tonight's working theory. If you've got a taxable account, Here's my question for the comments. Have you ever sold to rebalance and then run the tax math afterward? A new working theory every night at 7. This isn't financial advice, just the math.